Hi, Clay. It's so wonderful to have you on my podcast. Coming from a podcast host to another podcast host, I think it's always a humbling experience to have guests from the Investors Podcast Network to join my show, such as the likes of Robert Leonard and William Green, and now have you join me today. So, before we kick off the podcast today, how are you doing?
I'm doing wonderful. Thanks for inviting me to the show. This is fun.
You graduated from the University of Nebraska Lincoln with a degree in actuarial science and minor in mathematics, finance, and economics. Tell us more about your background and how you became a host of arguably one of the most important and underrated investment education podcasts in the world, We Study Billionaires.
Well, I appreciate those high words for the show. Just by happenstance, I ran into the investing world at age 18. I was born and raised in Nebraska. So naturally, I hear about this guy named Warren Buffett. And I'm like, what the heck's, going on with this guy? He lives in, a couple hours away from me. And he's like one of the richest people in the world. Yet he just kind of sounds like he just kind of sits around all day. So what's going on here? I'm not sure what inspired me to purchase his biography, The Snowball by Alice Schroeder. But for some reason, I bought that book and started reading it. And even then, I didn't love reading as much as I do today. And it's kind of funny looking back how a lot of the things I didn't like then, such as reading, I do all the time now today and, studying all these great investors. So even after reading that book, unfortunately, I feel like I wasn't able to get the hang of investing and be able to differentiate a good stock versus a bad stock. So along the way, I, kind of followed sort of what I call just a traditional path. I went to college after high school, studied to be an actuary, worked for an insurance company and then a smaller consulting company, and worked in Lincoln and Omaha. So I'd spent a few years in Omaha and was able to go to the Berkshire meeting. And along the way, I sort of developed this passion for investing and, just tuning into podcasts like TIP. That was by far one of my favorites. And yeah, I just really enjoyed listening to that show. And, anyone knows anything about the actuary side and working with insurance, like these people love working with numbers. So investing for me was something that was a super natural fit. It was something, someone that has sort of a math mind. Investing, you need to understand the numbers. So I worked as an actuary for 4 years, and just by happenstance, I got an email from TIP asking, or just letting their email list know that they were hiring for their millennial investing show. For anyone that knew me, they didn't see me as so I was probably the last person on their list they think would be a podcast host, but I loved TIP and everything they were doing. So I just sort of threw my hat in the ring and, feel very blessed and grateful to have had the opportunity to join them. So I hosted the millennial investing show for a year, and then I transitioned over to host We Study Billionaires. And then I'll also mention that this year, I've also helped TIP launch what's called their TIP Mastermind community. So I've been quite busy building out a community with our audience and doing some special things there. For example, we're going to New York City in a couple weeks and, building out those special relationships with other like-minded investors is something I feel like I wish I had when I was a listener of the show. So yeah, being a host, helping out with this community here with TIP is what I've been up to nowadays, and it's a lot of fun. I really enjoy it.
I think not a lot of people know that Warren Buffett almost became an actuary, and I think he would be pretty good at his job if he took on that career. But I know he ended up becoming an owner of Geico, which is one of America's largest auto insurer under Berkshire Hathaway. I'm curious to know, how did you come across investing, and did studying actuarial science in college help you with investing?
Yeah, so initially I came across investing through Warren Buffett and reading his biography. And one of the biggest takeaways from reading that book was understanding the power of compounding. When someone understands that, it's really hard to drop that investing bug because you just can't get the power of it out of your mind. Albert Einstein called it compounding the eighth wonder of the world. And Buffett, when he was younger in his 20s or even in his teens, when he held a dollar, he thought about how eventually, if he invested that dollar wisely, it would be worth at least $10. Essentially, he saw them as one and the same, whereas $1 today is essentially the same as $10 at some point in the future. And of course, he was very successful at utilizing the power of compounding and using it to his advantage. So in terms of how the actuary side helped me with investing. I would say that most of my learnings in terms of like specific to investing, those came from podcasts, reading books, and making a ton of mistakes. So it wasn't directly related to like what I learned in school or what I learned on the job. I kind of see school as more of a formality in a lot of ways. And, a lot of the things they teach, just people don't use. I learned about CAPM models in school, and I've studied a lot of great investors. I've never heard a single one of them say they used a CAPM model. Nick Sleep, Peter Lynch, Bill Miller, they're all talking about these practical things when it comes to studying businesses and investing. And it's interesting, like Bill Miller, for example, he's super interested in philosophy. So I think one unique trait with these investors is they're able to pull these lessons from different disciplines and pull them into how it can relate to investing. And then Nick Sleep, for example, I read his letters and he was highly influenced by this book called Zen and the Art of Motorcycle Maintenance. And I haven't read that book yet. I have it actually right next to me here. I plan to read it here soon. But that book really, really harps on, this idea and this concept of quality. And he takes this idea of quality and he implements it into how he runs his fund, how he invests in the highest quality businesses he can find and such. So that's not to say that school isn't helpful, but I think it's sort of the beginning of an education that you take on for the rest of your life. And I think being an actuary, it helped me in so many different ways, especially in like developing soft skills, such as developing a work ethic, learning how to work with people, figuring out how businesses work from the inside, actually working within one rather than just looking at an annual report or something.
Thanks for sharing that insight in terms of how your college degree would be able to help you when it comes to investing. So what does investing mean to you?
Yeah, Buffett has said investing is simply a way of putting money down today in hopes of getting more money in the future. Now, there are great ways to do that, and there are really essentially ways of gambling that people try and do that. But you could do this through the stock market, purchasing something like an index fund that's a basket of stocks. You could do an individual stock. You could do bonds, real estate, precious metals, art, collectibles. There's a lot of different things you can invest in. The most common way people invest is oftentimes through the stock market. And history tells us that over the long run, it's the most powerful tool we can use to invest our money to have more money at some point in the future. The overall stock market, like something like an S&P 500, it's averaged around an 8 to 12% return on average, but it's very, very volatile along the way. Some years are going to be over 30% gains. Some years are going to be 50% drops, 40% drops, and it's very, very volatile. So you have to understand that long-term perspective. And I think because of the volatility, I think a lot of people see the stock market as essentially a casino, and you have to get lucky to make any money in it. And I don't believe that to be true at all. A lot of people that talk about stocks, they talk about some of the riskiest things you can invest in, or psychologically, they get suckered into buying things at the exact wrong time. So they have recency bias, assuming that essentially what's gone up recently is going to keep going up. And usually when something rockets up, when it's doubled or tripled over a year, that's the time you want to maybe think about selling that investment and not trying to get into it. Just a general rule, because, the market is very humbling. I've heard the quote that it's a tool that inflicts the most pain on the most amount of people. So when people think the stock market's, done dropping, that's when it's going to probably drop a little bit more. And it really tests your senses and it tests your sanity in many ways, and it makes you really humble.
And I learned that you start investing at a very young age, at 18 years old. I'm sure there are people that, invested when they're in their teens, but I think that's pretty young. So how would you describe your investment philosophy?
Yeah, initially I invested mainly in index funds, mainly because I knew that, I didn't understand individual businesses enough, but I feel like over the past year or two, I've come around to understanding individual companies. But I'll talk about more about the individual companies side, because the index fund side is really just a DCA buy and hold for the long-term approach. And it's very hands-off. Whereas I love just diving into different businesses and understanding, what makes companies great. So I mentioned Nick Sleep, and I feel like my approach aligns pretty well with his. Essentially, I want to buy the highest quality companies that I can find at a valuation that I deem to be sensible. So oftentimes these types of companies, when they're really high quality, they tend to be trading at what many would call a premium valuation multiple. But I think that my edge is that I'm able to hang on to these types of companies for much longer than the average investor. So there's so many different types of investors in the market, and there's so many different reasons people own a company. So you have momentum traders, you have technical traders, you have all these different institutions. And some institutions, for example, they just have a mandate. Once a company hits a certain, size of their portfolio, they need to start selling it, things like that. So when you understand kind of your place in the market and what sort of edge you have, I think having that long-term mindset, I think, is an edge for me. And I sleep much better at night knowing that the odds are heavily in my favor with these companies that have these really durable moats, and they're really, really difficult to disrupt. So while other people might be comfortable with something that's trading at a much cheaper multiple, they might be much more ripe for disruption as well. So yeah, you have to keep a close eye on them. Another point I want to mention with this kind of quality approach is that these types of businesses, if you get the business right, they tend to bail you out if you happen to overpay a little bit. And what I mean by that is if their valuation multiples are, say, high at the period you enter it, the stock might not go anywhere for 1, 2, 3 years. But that long-term approach, if you get the business right, essentially the business is going to continue compounding. And essentially, stocks tend to correlate with the returns on the business. So if the business is doing really, really well, then over the long run, the stock is going to follow that. And some other points related to my approach, I think it's really important to the sensible valuation is still really important. You can't just find a super high quality company and then pay 200 times earnings for it. It's probably not going to work out well for you if that's your approach. Or paying a multiple of sales in like profitless companies. And typically what I would invest in is companies with long track record of positive earnings and earnings growth. And I think what helps me sleep better at night with this approach is that, I can come up with some sort of sense of what the intrinsic value of that business is, or Buffett's definition of intrinsic value is like, what's the true economic value of that company? And looking at their earnings and looking at the quality of the business and their growth runway. And when you own these quality businesses, their intrinsic values are going to increase day after day after day. So if the price you get in is maybe a little bit high, that the intrinsic value is continuing to go up over time. And eventually that's going to lift the stock price. And I've studied human biases quite a lot. And one of the popular ones is humans are generally very impatient, and people get bored when their stocks go nowhere. So maybe when a stock is going nowhere and the business continues to compound, that could be a really good opportunity to get into it because people like to chase just what's going up. So some other traits I like to look for in the businesses I invest in. So I really put a big emphasis on trustworthy managers that typically have high insider ownership, meaning that they own a lot of stock and they have a lot of skin in the game. I want to see high return on capital within the business because the returns of the stock tend to correlate over the long run with the returns of the business. I want a high reinvestment rate. So that sort of fuels this compounding engine to continue to push that intrinsic value higher over time. And then I want to see a growth runway at least for the next 5 years or so. One of the mistakes I made early on was, kind of valuing a business that paid out dividends. And Thomas Phelps, he wrote the book 100 to 1 in the stock market, and he called dividends an expensive luxury because if a business can reinvest back in itself at say 20 or 25%, then paying a dividend oftentimes is a huge, huge mistake because money that's paid out as dividends is money that isn't fueling that compounding engine that's compounding at a really high rate that a lot of businesses aren't able to do. So when I find a business with these types of characteristics, and especially businesses that have managers that really, really understand capital allocation, like a Warren Buffett, then I get really comfortable owning these types of companies. They appear to be trading at a high multiple. People say they're too expensive, but those types of businesses get me really, really excited because sometimes they can be underestimated by the market.
And I agree with a lot of stuff that you said. I'm curious to know, 18 years old till now, has your investment philosophy evolved over time? I know you're, because I listened to your conversation with Stig Broderson last year in 2022, saying that your investment philosophy is quite value investing focused. So I was wondering if that has sort of evolved over time.
Yeah, great question. So initially, I was very drawn towards index funds. And I'd say earlier on in my journey with TIP here, I was still kind of figuring out what approach made the most sense to me. And after I joined We Study Billionaires and really dove into this quality framework is when I really sort of came around to the philosophy that I really want to do. And I'd say before I mainly focused more on larger, more established businesses like a big tech, like an Apple, Google, Amazon, these businesses that are just behemoths and just really, really high quality businesses. But I think the problem with how it fits into this framework is the growth runway. I think it's really hard to assess Apple growing at, say, 20% for the next 5 years. It's really hard for me to assess how much they'll grow since the businesses are so mature and they are able to reinvest all of their cash flows like a lot of the other businesses I've found. And you mentioned the term value investing approach. I think that term has so many different meanings to so many different people. And I love how Buffett and Munger, they say all intelligent investing is value investing. So you might have one person who all he cares about is the quality of the business and he doesn't put as much emphasis on the valuation. Well, it's intelligent investing as long as he's paying below what he believes is a conservative estimate of the intrinsic value. Then there might be someone else who, doesn't put that much focus on quality, but they put a huge amount of focus on the valuation. Still, at the end of the day, they're trying to purchase something for less than it's worth. So that term value investing, I think it can be a bit deceiving to use sometimes because there's so many types of investors that can sort of fit under that bucket. I think a lot of people would call themselves value investors, and at the end of the day, you're just trying to buy something for less than it's worth.
That's a really good way to simplify value investing. But I definitely think it's more complex than it actually sounds, especially the behavioral aspect of investing. I'd argue that it's hard to segregate the behavioral aspect of real life, the decisions that we make every day to investing. So, for example, if you're an emotional person by nature, I'd argue that that person would find it very difficult to remove the same behavioral trait when it comes to investing in a company. So my question to you is, do you approach life in terms of decision making the same way as you invest in stocks and companies?
That's an interesting question. I'm keen to saying no, but in many ways it is yes. When you dive into investing, you inevitably run into Buffett and Munger, and they just share so much wisdom on life. And that's just really, really interesting because people get into value investing or they get into investing because they want to make money or they want to make a return on their investments. And then they stick around for how it ends up changing them as a person. For example, one of the big lessons that Buffett and Munger push is that the best investment you can make is not in any particular stock, but it's in yourself. And in order to be the best in your field, you need to be a learning machine. You need to continuously bring in new information and develop this passion for learning and passion for reading. And I think that's something a lot of the best investors, they really embody. They're really learning machines and they're always bringing in new information, questioning their beliefs, questioning what they think they know. And then another concept I think that carries well from investing into life is just the concept of opportunity costs. And that's Stig Broderson, our co-founder here at TIP. That's something he harps on quite a lot. If $1 invested in company A, that's a dollar that can't be invested in all these other companies. So you need to look at your opportunity set of what it is that you're able to invest in. And then when it comes to life, for example, you can spend your time, say, extra hours at the office or extra hours working, or you can spend that time with family, with friends, exercising. There's all these different things you can do with your time. You just need to figure out how you can best find that balance and be able to guard it from the opportunities that are really poor opportunities.
That's really insightful in terms of how you convert what you do every day in terms of decision making into real life. So moving on, you've interviewed some of the world's best investment lecturers recently, as well as Demoter and Chris Mayer and Tobias Carlyle, who is the book author of The Acquires Multiple. What were some of the takeaways and challenges with investing after speaking with them? What were some of the lessons learned there?
Yeah, you and I, we talked a little bit about this concept of mean reversion. And people like to think about, like, they sort of develop this line of thinking and then they just kind of get trapped in this line of thinking. And it's really interesting. When it comes to mean reversion, I think it's really important to understand it's like a fundamental law of capitalism and a fundamental law of business. I wanted to share this study I read recently. It looked at companies since 1926. I can't remember when the study ended, but essentially what it found was that 4% of businesses in the stock market produced essentially all of the excess returns above US Treasuries. So US Treasuries are a very safe investment. You know what sort of investment you're going to get. As long as the US has money to pay their bills, then very likely that they're going to be able to do that. Then you're going to be able to get a return on US Treasuries. Well, I think when someone gets into the stock market, they kind of assume that, okay, 50% of businesses are pretty good businesses and 50% are pretty bad businesses. Well, what you find when it comes to the stock market is this power law where a small number of companies essentially drive all the returns of the index. And one of the big takeaways from that is that a business might be really good for, say, 5-10 years. And when a business is making a killing in an industry, people just don't sit on the sidelines and just watch them continue to crush it. They want to come in and eat their lunch. And a recent example of this is a company like Peloton. This company, they built this fantastic brand. They built this fantastic product. They are just a high flying stock and everyone's going out and buying Pelotons. And then COVID just accelerated that sort of a trajectory. And then there's all these other businesses and all these other people. They're like, I can make a product just like Peloton and sell it for half or 40% of the price. So essentially their returns essentially get arbitraged away, and then they have issues growing into the future. And this relates to this idea of mean reversion. When a company does really well, it tends to revert back to the average performance of a business. And when a company isn't doing so hot, it tends to revert back and do a little bit better in the future. Now, on the other hand, there still are those 4% of companies that, kind of defy the laws of this law of gravity or this law of capitalism. And it's the Amazons, it's the Apples, it's the Walmarts that just continue to compound year after year after year. And a key point of why they're able to do so is the economic moat that they've built. So they've built this business and they have some sort of aspect to it where companies aren't able to come in and bring those returns down within that. So one thing I've come to really appreciate about investing is that, the world isn't black or white. It isn't that all companies mean revert or all companies don't. I think a big takeaway is that the world is much more complex than some people might make it out to be. And you need to be careful when you have this either or thinking or this simple if X then Y thinking, where if a business has done well over the past 5 years, then you have to be really careful assuming what it's going to be able to do in the future. So again, when you hear that study that 4% of companies drive essentially all the returns in the stock market, I think, again, it makes you really humble as an investor. And yeah, I'd say that's one of the lessons I've really learned. The guests you mentioned are brilliant investors and I've learned a lot from them.
So do you believe in mean reversion? And do you think as investors, we can really take advantage of it? And the reason why I asked that question is because I'm listening to Tobias Carlyle, and he says something along the lines of mean reversion is the expected outcome, but we don't actually expect mean reversion. Instead, our instinct is to find a trend to extrapolate it. So in a way, you take advantage of people continuing to buy the stock, or not caring about valuation, and you either think that the valuation of the company is not worth as much, and then in a way, you take advantage of the investment alpha. And I think there are two reasons why mean reversion makes sense. Is one is because competition is behind mean reversion. High profits attract competitors, and competition eats into the profits and growth. Losses cause competitors to fold, which allows high profits for survivors. It's essentially a cycle. And second is profit margins. I think Jeremy Grantham had a quote, and I'm quoting him right now. He said, profit margins are probably the most mean reverting series in finance. And if profit margins do not mean revert, then there's something wrong with capitalism. And if higher profits do not attract competition, there's something wrong with the system and it's not functioning properly. So I think these quotes are really powerful, and it makes me question, one, is our markets efficient? And two, can we be more of a contrarian investor over the long term so that we don't fall into the pitfalls of 100% loss in a investment? So what are your thoughts on that?
Yeah, I think the most important thing, I think, is to understand your place as an investor, how much you know and how much you understand about the markets. And, I see Tobias Carlyle and I see someone like Chris Mayer, who wrote a book, it's right behind me, a wonderful book called Hundred Baggers. And they both understand this concept of mean reversion. They've studied investing like crazy, and they've both found an approach that works really well for them. And it's two very different approaches. Toby, he likes to find something that, the market is too pessimistic on. So essentially they maybe have low returns now, but eventually they're going to revert back, and he's going to capture alpha that way. And then, flip it and you look at someone like Chris Mayer, he's trying to find those businesses that's kind of in that 4% slice where there's some characteristic about them where it goes against that Grantham quote where their profit margins aren't being, tapped into by competitors. And there's something about their business where I just think about some of the businesses I've studied that Mayer owns, and it's just a management team and a business that is so uncharacteristic of how just other people and other businesses operate. I mentioned the bias earlier of being impatient. A lot of businesses and a lot of managers, they just are really impatient. They want the cash today. They want the returns today. Whereas there seem to be some managers and some businesses that just seem to be cut from a different cloth, where they're able to delay gratification and they're able to maybe take some pain today for some benefit in the future. So, it really ties into how to think as an investor of how these managers are operating. And of course, there are going to be businesses that you think are just extraordinary businesses and you think they just have impenetrable moats. I mean, you could look at companies during the 90s, look at a Kodak, you look at a Blockbuster. It seems like these were just amazing companies, and they were just, opening all these new stores, and they were just growing their business so much. And you think that they just have these impenetrable moats, and now these companies aren't even around today. Again, you just have to be humble about what you think you know, and always be willing to continuously learn and reassess what it is you think you know.
Well, appreciate the insight and your takeaways. You've read many world's greatest investors' shareholder letters, including Warren Buffett, Howard Marks, Mark Leonard, founder of Constellation Software, just to name a few. What are some of the takeaways and the biggest misconceptions that we thought financial literacy is this, but after reading their letters, it's not what it's perceived to be? So what were some of the takeaways and findings?
I feel like there's sort of two parts to this. There's the financial literacy side, which is sort of basic concepts to building wealth. And then these investor letters are really lessons when it comes to business and investing, the way I see it. So when it comes to financial literacy, I think that there's a few misconceptions that come to mind. I think one of them is people thinking that they can wait to start saving and investing. And once you understand the power of compounding, then you know that you need to start saving as soon as possible, because the sooner you start saving, the sooner you can let that compounding really start working for you, because the longer you're able to do that, the more exponential benefits you're going to get. And the exponential side is really, really important to understand because of how powerful it ends up being decades down the road. And then a second big mistake when it comes to financial literacy, I think, is thinking that investing should only be left to the professionals. And I think with low cost index fund nowadays and with the Vanguards and Fidelities of the world, anyone can handle investments themselves. And it's sad to see a lot of people being essentially overcharged by a lot of investment professionals. And essentially they're just outsourcing all this and they don't realize what the true cost is of doing that. I don't want to harp too much on that, but turning to the letters that you mentioned just incredible people. People know about Buffett, but not as many people know about Mark Leonard and Nick Sleep. I'm a shareholder in Constellation Software. Mark Leonard is the president of that company, and he is just a master capital allocator. Had returns on invested capital around 25% for ever since he started the business. I believe he started in the late 90s and they IPO'd in 2006. And people said for years, this company's bound to mean revert soon, but it just never happened. And you see a lot of similarities with Mark Leonard and Buffett, where they are just so honest and transparent. They undersell and they over deliver. They just operate so unconventionally, like I mentioned, where some of these managers, these businesses are just cut from a different cloth. And then you also mentioned Nick Sleep, and his quality approach really resonated with me, because one thing I love about this approach is you're able to find a business that operates differently and they're able to have these high returns on their business and they're able to reinvest, and they have managers who think long term. They're very patient. They're very shareholder friendly. And you're able to buy a business like this today and just sort of hang on to it for decades. Whereas with a lot of other approaches, you need to continually shift in and out of stocks. You need to continually watch them. Of course, you need to still watch your quality businesses, but you might need to keep a closer eye if you know that you might need to sell this thing if it has an earnings miss or you see a competitor coming in. So it's a little bit more of I see it more of as a laxed approach where you're able to sleep better at night, knowing that your managers are treating your capital as if it was theirs. For example, Mark Leonard, he wrote in one of his letters that I guess early on in his career, he worked all the time, and he was all about growth and learning this kind of this formula to making all the acquisitions that Constellation Software does. And later on, he's hired his team. He's got his team built out and kind of picked up the tab on all the extra hours he used to work. And he mentioned that he's going to start flying first class and be a little bit more relaxed. And this business still is doing incredibly well. And he's just mentioning how he's going to be paying for first class out of his own pocket. And his salary is $100,000. And all of his net worth essentially is tied into shares of Constellation Software. So that if the stock goes down, he's suffering just as much as you are as a shareholder in that company. And he's not issuing stock options, diluting shareholders, paying out these massive bonuses to managers that may not deserve it. So again, it's really interesting to find these guys that write these letters that just seem to do things much differently than what you see on the face of Wall Street or the face of the investment industry.
On top of that, given that you've studied so many shareholder letters of the world's greatest investors, what are some of the common similarities in terms of the personality traits that they have that makes them so successful today?
One trait I found from these great investors is a very great sense of humility. I've kind of already harped on this a little bit, but these great investors, they understand that they aren't going to bat 100%, and they aren't going to be right on all the investments they make. And they're humble enough to understand that their investments can always turn against them. We've talked about this. Capitalism is very brutal, and companies that earn high returns today, there's going to be companies that are going to try and, take those returns from them over time. And what may be in favor today may not be in favor in the future. So even if the business is doing well, the stock might be dropping like a rock. For example, during the tech bubble, tech stocks were just going through the roof, and Berkshire stock was just going down. And Buffett, he had to consider, was he going to hop on the tech train like all the other value investors that got suckered into it? Or was he going to stick with his philosophy and stick with his approach? And that sort of experience keeps you humble because even though Berkshire was doing just fine, the stock was just out of favor. So sometimes your businesses can be doing really well, but the stocks themselves might not be doing well either. And you just have to remain humble and understand that sometimes there are going to be people next to you or friends texting you that seem to be getting rich practically overnight on something that makes zero sense to you. And it's just a total, not a fad, just something that's just total hype. People are just jumping in solely to make money, not because they understand what they're investing in. And I think tying into the humility of this, I think they also understand that there's some element of luck when it comes to successful investing. And we shouldn't act like we know with 100% certainty where the world is heading. It's just sort of trying to stack those odds in your favor and taking advantage of those opportunities when the market does offer you those really great opportunities. And be careful holding opinions really strongly. And Munger talks about being able to let go of your best loved ideas, because sometimes it's just time to part ways with what you thought was one of your best ideas ever.
Is there an investor or a guest speaker that you've invited in terms of who do you admire the most and one that truly stands out from the rest?
Yeah, one investor I think is largely overlooked by a lot of people is Chris Mayer. I've interviewed him twice this year. I have his book, 100 Baggers Behind Me. And then the other time we talked about another one of his books called How Do You Know? During that chat, we talked all about this topic of being humble, understanding that not all of your investments are going to work out the way you like them to be. And when it's time to part ways, you need to learn to part ways with them. And his episodes on my podcast were some of my most popular ones. So a lot of people know who he is, but I think that he is just operating in a way that is so unconventional relative to so many other fund managers. I think a lot of Wall Street managers, they're very short term and they really don't want to shy away from the index in terms of their number of holdings or what the returns end up being. I've heard some firms call themselves a concentrated fund, and then I look at the fund and they have like 50 holdings. And Mayer, he runs a family office that started, it was seed funded by a family he was close with, Bill Bonner, and he owns, to the best of my knowledge, he owns 11 stocks, and he believes that's diversified enough. And I think that's something that's so unconventional when it comes to a lot of fund managers. And the tricky thing with investing is that there's only so many really good ideas you can find. And if you think you can find 50 really good ideas and a couple of them end up really moving the needle, say your very best ideas end up moving the needle, well, it's really hard to like lift the portfolio if your best idea is a 1% or 2% or 3% position. And I think Chris has really nailed down his very best ideas and only allocated towards those and got enough diversification where he's removed a lot of the company specific risk, but still really reaping those benefits of concentration and not spreading himself too thin and allowing his best ideas to really make a difference. He's willing to really think outside the box and think differently than a lot of other managers. He's got this approach where he knows the types of businesses he's looking for, and he really sticks to that philosophy of finding these really special compounders. Some of these companies are consistently growing their earnings by 30% more every year. And then these companies have zero dilution. They have a lot of the characteristics I mentioned at the top where the insiders own a lot of stock, and the consistency of these types of businesses just is something you don't find often. I just think it's really special. And his returns aren't public, but I think if you were to compare his returns in recent years to some of the big names in the investment industry, I think it would surprise a lot of people. And I think one of the reasons, he might not be in the limelight like a lot of these investors is he's still early on in his journey as a fund manager. He started his fund in 2019, and I would think his returns are just some of the best you'd see anywhere.
I think that's really interesting. I think more people in Asia should, look him up and look at how he makes decisions and read his book. So I think he's really underrated based on what I saw watching your interview with him. On top of reading shareholder letters, from the world's greatest investors, you read a lot of investment books. Do you have a favorite one that you might want to share with the audience and people that's listening to this podcast?
Yeah, I have a few favorites. I'll talk about one of them, but I'll say that Hunter Baggers by Chris Mayer is probably my favorite. But I've talked a lot about the concepts in that one already in this episode and sort of adopted a lot of Chris's thinking. And if you want to learn more about Hunter Baggers, I did a YouTube book review on it and I interviewed Chris all about this book. So you can go there if you want to learn more about it. But another book that's I think is just so powerful. It's sitting behind me. It's The Joys of Compounding by Gautam Baid. This book had so much timeless investing wisdom and so much life wisdom in it. And it was so good that I ended up recording 5 podcast episodes just on this one book. Usually when I read a book, I just record one episode on it. I'm just like, there's no way I can do one one episode. And I asked Stig if he mind if I did a series. He's like, yeah, go ahead. And then I ran it by Gautam Baid, the author, and he said, go ahead. I'm curious if you've read this one.
I've not. I think maybe more people should read it.
Yeah. Well, you'll have to go pick it up. I'll share a couple of my big lessons here. In that book, he shared a study that looked at various businesses over time, and it kind of relates to that mean reversion concept earlier. This study that he shared in that book, it looked at businesses and their returns over time and the returns on capital. And he very much adopts this sort of quality framework as well. It split it up into 4 quartiles of like the highest quality companies, and then you have the lowest quality companies earning the low returns. And he was essentially sharing that, there's this subset of businesses where those that earn these high returns, there's a portion in there where they tend to stay in that top quartile for a really long time. And it sort of relates back to that 4% of companies. When you think about it as like 4% of companies do really, really well, it seems like the odds aren't really in your favor. But when you remove a lot of, say, industries, or you sort of filter down on these characteristics of what you tend to see in these outperformers, then I think the study essentially illustrates that once you find some of those companies that earn those high returns and they have these certain characteristics, they tend to stay up there for a lot longer than a lot of people expect. So that study was really interesting. I don't remember the exact numbers, but it was something like 40% of names in the top quartiles tended to stay in the top quartile over the next 5 years. You'll have to check out the book to get the exact numbers on that study. But another big takeaway I had from that book was that macro forecasting is largely a waste of time. When I look at the world's greatest investors, practically none of them make investment decisions based on where interest rates are going, what the Fed's going to do, where the economy's heading, etc. A lot of people that make the headlines when it comes to the finance, business, investing world, they're making these macro forecasts, and the returns that these people get isn't anything that we would want to achieve ourselves. So it illustrates that macro forecasting, it's practically impossible to do well on a consistent basis. And the reason for this is because you might be able to predict like inflation's coming. And because inflation's coming, the Fed's they're going to have to raise their interest rates to fight that inflation. And then you're going to see markets crash. We ended up seeing that happen. And a lot of people predict that inflation was going to come, that the Fed's going to raise rates. And they also predicted that the market was going to crash. But the market hasn't crashed. And it's been over a year since they raised rates. And you might be able to predict some of these macro factors, but determining how those macro forces are going to affect markets is very, very difficult, if not impossible. So to give you one example, Michael Burry, he's famous for capitalizing on the great financial crisis and the crash and making billions there. But people in 2023 seem to still take his opinion seriously, and he's a good person to put on a headline to drive clicks. But I don't think people realize that Michael Burry has called for a crash ever since the great financial crisis, and he's been wrong every single year. But people still seem to think that his opinions and his forecasts are, he's kind of the guy that can make all these predictions, but he ends up being wrong essentially every time. So yeah, the joys of compounding, two big lessons was certain types of winners tend to keep on winning, and macro forecasting is largely a waste of time.
Thanks for sharing your takeaways. I definitely have to pick up his book. I think it's definitely something that's worth a read, especially you've done 5 episodes on him. So I definitely will pick up his book. What was your biggest takeaway or mistake when it comes to stock market investing? I know you've mentioned a few earlier during our introduction, but I was just curious to know what was the one that really is a learning lesson for you.
Yeah, there's so many lessons I've learned just through experience. Just off the top of my head here, there's one big one was assuming that high growth would end up leading to high stock returns. But you look at a company like Snapchat, their business has grown tremendously over the past few years, but their stock has done terrible. So you need to be careful the assumptions you make when it comes to investing. And then a lot of these tech companies, they use these terms like adjusted EBITDA, and they'll kind of mask how the company's actually doing underneath the surface. And I think being very wary of adjusted EBITDA is something I would tell my younger self. Not all growth leads to stock returns. Essentially a business needs to be able to reinvest at a high rate, and a business could invest a lot of money and achieve a lot of revenue growth, but that might not lead to really any earnings growth or any value creation. I think that's an important concept to really understand, is understanding that a business needs to earn above essentially what many investors call just earn above their cost of capital, or what it costs to raise equity or raise debt. And I think stock-based compensation is something that gets lost on a lot of investors too. They might issue a ton of stock-based compensation, and it's not really shown in the earnings oftentimes. And it's a real expense. It's essentially shareholders being diluted to fund the business's growth and then fund these managers' really big compensation packages. So I think stock-based compensation is another thing that's really, really important to understand and sometimes is overlooked.
Thanks, Clay, for sharing your biggest learnings. I think this is the most humbling part when it comes to learning from other people, learning from mistakes, not just from your own, but from other people. And this pretty much wraps up the episode. So I want my audience to listen to you more on the Investors Podcast Network, We Study Billionaires. Where can my audience find more information about you?
Thanks a lot for having me. This is a fun chat to be able to share some of the things I've learned from doing this for a couple of years now. You can find me on the We Study Billionaires podcast. Usually my episodes are either on Thursdays or Saturdays. I do one a week. You'll find me interviewing great investors. You'll find me interviewing exceptional authors, doing book reviews on some of the favorite books I've read. I've shared my lessons from all these great investors: Nick Sleep, Terry Smith, Peter Lynch. So yeah, you can find me on the We Study Billionaires podcast. And then I'm also on Twitter at Clay_Finck, Finck. So you can also connect with me there as well if you'd like.
Brilliant. Thank you so much, Clay. That concludes our podcast episode. And it's such a pleasure to have listeners all the way in Asia to listen to your sharings and, biggest lessons when it comes to investing. So once again, thank you so much for your time.
Thank you. It's a lot of fun.